Better earnings worldwide, improving data, boosting the outlook for equities.
The pain trade is that we continue to just grind higher.
Grind higher.
Grind higher through the second quarter.
Melt up.
Melt up.
Some variation of the melt up.
The market has largely been fueled by the idea that the Fed is now on hold.
The Fed and the ECB pivot in a more dovish direction.
Chinese economic data has improved.
Solid to stable economic growth.
Recession fears are falling.
Decent earnings.
All of this is being supported by still very easy monetary policy.
Slow and steady with quiet central banks actually is a pretty nice prescription.
Momentum is good and people are not overpositioned.
We could see investors get even more enthusiastic about the markets in the short term.
Joining us around the table here in New York is Bob Michele, JPMorgan Asset Management Global CIO and Head of Global Fixed Income, Peter Tchir, Academy Securities Macro Strategy Head, and George Rusnak, Wells Fargo Investment Institute Co-Head of Global Fixed Income. Bob, let's begin with you. Is it that simple that risk assets just keep grinding higher from here?
It feels that way, and it doesn't feel like something you want to fight right here. While it's tempting to take profits and wait for some pullback to get back in, it means you have to get two things right. It means you have to be correct that this is the point to take some profits, and then you have to be right to get back in. Why go through all of this? Just enjoy the ride.
What do you think, George?
Great economy, you have great GDP, great low inflation, you have a Fed on hold. Does beg you to take more risk. But risk assets have done quite well. We think it's actually a little bit of an opportunity to get a little bit more neutral here. Not necessarily negative, but a little bit more neutral here.
After an 8-9% run in high yield so far, Peter, you can see why some people feel that way in fixed income at least.
Yeah, we've turned bearish actually last Wednesday for the first time. So the S&P was just above 2,900. We've been bullish all year. I don't like the S&P 500 here. I also don't like high yield. I think we could see a little bit of spread decompression. So I don't think we're going to see anything like what we saw in November, December in terms of bond markets. But I think high yield could be poised for a little bit of underperformance.
What underpins that change in thought in the last week, Peter?
I think no one liked this market 2 months ago. Very few people liked it a month ago, and now everyone seems to like it. And as a contrarian, I've seen the sentiment versus fundamentals kind of get a little bit out of whack, and people are too positive. I think we're going to have some negative surprises on the trade front in particular.
What do you think about that, Bob?
I think there's too much money in cash. I think it's been going into cash for the last 3 years, waiting for the Fed to finish hiking rates. They were supposed to finish hiking rates at the end of this year, not at the end of last year. That money has yet to come back into the market.
Well, let's talk about the prospect of a melt up. Larry Fink in the last week making a lot of headlines about that very prospect, that we melt up, that stocks go higher, that we finally get that participation. If you look at the fixed income side, it's very hard to make the argument that we haven't had the participation in risk assets in fixed income. We've had a lot of money rotate into high-yield bond funds, into investment-grade bond funds. The evidence is there, isn't it? Haven't people been participating in this rally?
The evidence isn't there. You would have thought that the 10-year Treasury would be 280 to 290, maybe even 3%, that all the flight to quality in the fourth quarter would have reversed itself out. And it hasn't. So there's money that continues to leak into the market. I think it's healthy. I think it continues through the year.
What do you think, George?
I think that we've seen a fair amount go into fixed income, go into the equity markets. We like them here, but we just think you've had a great run. Pull back just a little bit, right? Both in the equity market from an asset allocation perspective, just slightly, and then in the bond market as well. I think there's some pretty good opportunities actually to get a little bit more neutral on duration, on yield curve right here.